Hi, hello, namaskaram. Wherever you're listening, let's talk about mastering the bearish pin bar candle pattern. In this thing, we will understand how a bearish pin bar candle forms and how traders can take advantages. Important thing is this forms when there is a long-term trend happens, then after the long-term trend, how the market reacts. So my name is Niranjan. Let's dive into this. Before that, let's look at the disclaimer. The examples which are discussed in this class are specific to educational purpose. So if you do not think these are recommendations, consult your financial planner, conduct due diligence, and understand the risk. And for people who do not understand the candlesticks, and there are other candlestick classes or courses which I have developed, so you can go through that. In this candlestick, what is a candlestick is, if you see this is white or look at it from a green, nothing but positive candle. So it opens here and it closes above the open. Any candle which opens above the which closes above the open is called a green candle. The same thing in opposite direction, black or red candle, where the open is high and the close is less, that is where open is less than the close. The open is less than the close. No, open is higher than the close. So basically the example is, the stock is XYZ stock opened at $10 and they closed around 9, so something like that. So let's go with the pin bar candle, how things happen. It is a small wick. Sometimes you may not see the wick, but pin bars are like, just think it's like a pin bar. How it's got name is simple. By pin, it looks like a pin and it has a bar here. So this is a bullish pin bar. But in this class, we will discuss, or in this presentation or video, we will discuss purely about bearish side. Just giving you an example so it will really enable you to understand how things are this. It opens here, but almost it goes up to here, in sense market is falling, but there is operators coming and buying and closes here. So it is like that. Here if you see here, the operator was, I don't want to say the operator, the stock price is open here, but the closing has happened here. But people or investors, or all the market participants moved up to the top, sucker, it closed below. This shows the weakness and this shows the strength. I just kept both just to make sure you understand this. So bearish pin bar candlestick is something like signaling a market reversal. I should able to identify a pattern. I will show you how you can identify the patterns. There are a few examples. We'll go one by one. Identifying a pin bar candle. You can see here how it is. Sometimes it can form this side also, but make sure this side also. So these two are kind of in a bearish sentiment. These two, this is somewhat, I think, positive sentiment. These are the different kinds of pin bars. So you can see how with the bullish pin bars, mostly the openings and closings are on the top rather than at the bottom of the candlestick. All these are bearish and all these are bullish. So take a look at the screen, and if they form kind of RSS when they're overbought or oversold, bang, you can take a position. You can take option spreads, you can do some spreads. I think the call spreads, credit spreads, I would recommend. So bearish pin bar pattern, I'll go into the more I think in options and features thing. We'll discuss further how you can use it. So here it has formed and you have seen how much. So technically the selling pressure has started all the way from here. It almost, if you have taken a position sometime here, you would have made. The same thing applies to here. The selling, there is something like pressure in every action, buying side or a selling side. Selling side, though, so much pressure is there on the top. It might be the operator is offloading, and it might be on top someone would have been bought too much and they want to show the real patience to that person. So even in the short term, you can look at this as a stop loss. I mean, I don't this as a stop loss because this is the high, and you can keep this one. But sometimes all depends upon what is that you're buying and selling. So types of pin bars, you can call this a hammer, shooting star, inverted hammer, and hanging man. So just you have to understand how you can identify. Bearish pin bar is one day reversal pattern with low reliability. Yes, the reliability is low because you have to look from a pattern point of view. If the pattern really forms after a good mm, trend, I think you can consider that as a probability. It all about probability where you look it. So pin bar is a distinctive candle pattern, signifies potential market reversal, consists of a long upper wick and a small real body. So these are small real bodies and long upper wick, and the buyers are overwhelmed and the prices are closed near the day's low, because when it is simply, if I have to say, from a bearish or a bullish independent of the pin bars, whenever the price is closing at the highs, almost at the highs, above the average prices traded for the day, I would definitely say that is an I don't know, good trending day. If it is closing above the averages, then or near the highs, it is a good green candle closure. The opposite is a red thing. So let's go ahead and see this one. See, if you see the pin bars here, bullish pin bar has happened here and bang, almost next 1 2 3 4 5 6 7 8 8 means 8 weeks, 2 months non-stop rally has happened in the same UPL 480. Somewhere it started 560. That's a good move, almost 20% move you have seen. And pin bars, this is something like fake, I would say. If the same pin bar, if would have happened sometime here inverted with a long wick, I would have taken a position. You can see something like that. Long wick bars are not here, but somewhere here if you consider. So yeah. So let's go into the more characteristics of a pin bar. Elongated upper wick, small real body, downtrend. We have seen that. You have seen here where a bearish pin bar here happens on a daily level 1 2 3 4 5 6, and if you have seen the high, it didn't broke this high and the stop loss is still intact, and you made around 1900s to 1750, 150, or yeah, somewhere around 150 points you made. So that's a good move again. Again you see the bullish thing happen, and none of the candle closed below this, and it went up to 2100 from 1750. The RSI do supported somewhere around 40 somewhat. We will talk about RSI further in the courses. Identifying pin bar, I'm going fast, let me come back. Identifying bearish pin bar in the market, recognize the shape, identify the color, and observe the size. Identify the pattern, confirm the trend, and time the entry. We talk about the timing here. Timing is very important. Market conditions, underlying market conditions are very important. If you don't, if you neglect them, as I said, there is always a lower probability. But if you want to consider multiple indicators and market trends, that is going to change. Interpreting the market psychology, it is clearly said, if the long wick is there after a very good highs and closing somewhere here, then there is something wrong in the market. You don't know, but the market is indicating that. So psychological significance is also there. You have to be careful in this kind of entries if you are trying to go long. Short is okay because you have stop loss. Of course, longs should also have stop loss. Entry levels and stop losses, that's what we are talking in this slide, so make sure you have that one. Optimizing position sizing and risk management. Position sizing is more important. Avoid the war leveraging situations, because your capital is life in your finance markets. If the capital is not there, your life is not there, or you can't breathe. Simple. Stop loss placements, diversification. You have to do trend confirmation, swing trading, momentum trading, all can be done, and backtest historical data. You have to do your homework, validate with live trading, and optimize the strategies. You can optimize the strategies by using other things we'll talk in the next slides. Avoid overconfidence in your trading. Ignore market. Do not ignore the market context. Do not be emotional and inadequate. Risk management. Do not fall into these common pitfalls and mistakes. People become over emotional, overconfident in pattern recognition. They find it because market, they don't like the stocks. People are highly emotional, so you should never be emotional. If you are emotional in stock markets, you have to be rational, not emotional. This is nice word. You have to be Hare Krishna. You have to be uh, rational, not emotional. So ignoring the market context, you should not be ignoring. You should not be emotional. You should not. You should always have an adequate risk. Combining bearish pin bar with other, these are the things what I said, like in the one of the slides what we will discuss. Supporting trend, volume analysis, confluencing with other patterns like MACD or other things, RSI. You should be in a good state. Case studies, examples you have to always do. This is one of the examples, but go back to your drawing room or exercise room or working room. There you have to find out at least 10 scenarios were good things, and keep them under your journal, electronic or physical journal, which is going to help you in revision. Thank you. That's all. I think you had a good time. If you liked this thing, just connect with me or thumbs up. Thank you. I have one more thing I would like to say is I have learned almost like $50,000 I spend on different courses, so I'm just giving this out free. If someone really wants to know 1:10 trades, then do connect with me. I can help you in 1:10 trades. So thank you, and yeah, I think after connecting we can talk about 1:10 trades, or there is a link below. You can connect with me. Thank you. Bye all.